Well, the post-pandemic real estate reality is taking a toll on the office sector, with employees opting for remote or hybrid work instead of a return to the office full-time. The share of people in office full-time dropped to 42% in the second quarter of 2023, according to the Flex report. The sluggish return to in-person work is hitting share prices for some of the largest office landlords, dragging down market sentiment on the future of office stocks. Here with more on the pulse in real estate, we have BMO Capital Markets Managing Director John Kim. John, is there any indication that there's going to be a turnaround?
I think the quick answer is no. We're riding a perfect storm right now in office when you have a secular question mark whether or not people are going to come back to work, how many people are going to come back. You have a cyclical downturn. Companies are downsizing. We just heard Ali talk about Amazon downsizing and cutting costs. And then you have the financing environment where interest rates have risen dramatically over the last 12 months. And that makes it much more difficult for office owners to refinance debt that's due over the next couple of years.
So, John, is the worst still ahead then, it sounds like, maybe for office space?
I think the worst is ahead. I mean, we have a couple of years where it's going to be very, very challenging. And we need the economy to really pick up. We need employers to start hiring, rehiring, expanding their workforce. And then there needs to be a real adoption on return to the office, because right now it's hovering around 50%. There's not many cities that are above 50% office utilization. Having said that, the office REITs are trading at historically low multiples. We're looking at GFC type multiples for a lot of the office REITs. Yesterday, Empire State was up 11% on releasing a space that Signature gave up, and the bank that took over Signature decided to take the space, and the stock went up 11%. So that just shows you how bad sentiment is for office right now. And any inkling of good news will provide at least a short-term boost for the stocks.
Yeah, John, I thought it was interesting. You said the sentiment is so bad you expect cab drivers to start saying that they're shorting any of these names as well. Is there a play to be had here, though, given just how far these names have fallen?
I think there is if you're looking as a value investor over the next 2 to 3 years. But if you're looking over the next 6 to 12 months, most of us tend to be short-term investors. The headwinds and the headlines are just going to be so significant. So I would say avoid for now. But if you're looking over the next 2 to 3 years and saying, look, we've never seen multiples this low. When you look at the multiples back at the GFC, they did rebound when the economy improved. That's when you could see or make a case that office could get better. But a lot of stars have to align for this to happen.
John, are you seeing any trends by sector in terms of who is re-signing their leases, or on the flip side, who is letting their leases expire and then either downsize or just not lease office space at all?
Right now, it's financial services firms that are very active in the market. That's why we tend to like New York better as a market than we do the West Coast office REITs. Small businesses are very active. A lot of small leases are getting done. But when you look at the leading companies in New York, whether it's Blackstone, Goldman Sachs, the hedge funds, now BlackRock, they're all returning to the office and mandating it for their employees. And that's a big difference between a lot of the financial services firms and the tech firms that are very, very reluctant to bring their employees back.
What about flexible workspace? I mean, certainly you can expect, especially these tech companies, if their lease is up, they're not necessarily going for long-term leases anymore. And yet there seems to be at least a desire on the part of the companies for some form of in-office work.
I think that's, at the end of the day, most people and most managers want their employees to be back in. And I would say most employees don't mind being back in the office. What they don't want to give up is flexibility, and what they don't want to have is a daily commute that could be pretty long. So I think the flexibility is the key term, whether it's flexible leases. Maybe some office owners provide more flexibility on the lease terms. We haven't seen that really quite yet. Or flexibility as far as what employers offer to their employees, just to keep them happy and make sure that they have enough independence on their free time.
So, John, office under a tremendous amount of pressure. What about some of the other areas, though, of commercial real estate? When we take a look at industrial, multifamily, retail, where are we seeing the most strength there?
So we like industrial the most out of the ones you mentioned, actually out of all the sectors within real estate, because there's a lot of embedded growth in the leases. We're talking about, in some cases, 50 to 60% embedded rent growth in the leases when you just market to market. So even if market rents start to come down, which we're not seeing this year, there's 50% growth in a lot of the industrial REITs. Multifamily is the sector that we tend to like, but we don't know what's going to happen over the next 12 to 18 months. So if the unemployment rate goes from 3.4%, hovering towards 5%, then the growth of rents is going to decline pretty significantly. So we're a little bit more uneasy on multifamily than we are with industrial and some of the other short-term asset classes.
A lot of uncertainty there. BMO Capital Markets Managing Director John Kim, good to talk to you today.
Thank you.